Okay, this is Terry again. Let's see, we need to bring up Chapter 2 and financial accounting, and again we'll start out with some terminology. The recognition point becomes the first issue as when do you record a transaction. Probably the easiest way is to give you an example. Let's get rid of this little guy and push him out of the way. If I come over and mow your yard, then what I would do when I got home is I would go ahead and record accounts receivable and revenue. The idea here is that as soon as I have completed my part of the work of the agreement, then I have a legal obligation to receive that money, irregardless of when the cash comes through. Later, then, I send you a bill in the mail, you send me back a check, then I'll record the cash and take off the accounts receivable. So again, accounts receivable, as we talked about in the last chapter, takes care of your timing differences, but the issue is we're going to recognize that revenue when we completed the service, not when we got the cash. That's the accrual basis of accounting. If we were on a cash basis of accounting, which would be very small businesses, then they wouldn't do that because they'd have no accounts receivable. They would not recognize revenue until cash was in their hand. They wouldn't recognize an expense until their cash left their hand. We're going to work with strictly accrual accounting. The cost principle then turns around and says, well, what do you record it as? So if I go out and buy a piece of land, the asking price was $120,000. It has a fair market value of $110,000. So the asking is $120,000. It has a appraisal value or fair market value of $110,000. But I agreed to give up $100,000 in cash. The cost principle says you would record that land at $100,000, irregardless of what the other two numbers are. So the issue is the cost principle says what did you give up, and what you gave up, that value then becomes what you record the land at. This whole concept of double entry system was created by Fra Luca Pacioli in the let's turn my little light on here. There we go. Fra Luca Pacioli, Franciscan monk in the 14th century. They didn't have very many Walmarts back then, so he wrote all of his double entry system into the margins of Bibles. The idea is that with every transaction, that economic event, every transaction you record, it affects at least two accounts. The accounts then are every piece of paper that we're going to keep track of dollar values. So, each pot of money becomes an account. So cash is an account, accounts receivable is an account, accounts payable, land, building, common stock, etc. They're all accounts that we're going to keep track of that information. The way that we keep track is we start out with the general journal, and that general journal is a chronology. If I spelled that correctly, it's a chronology. It's all done based on time. So you would go in, and on the first line of the journal paper, you would put the first transaction, then the second, then the third. Because of that chronology, then you don't have a running balance in any of the accounts to know what their value are. So a general ledger then is a listing of each one of these accounts. So again, you would have a general ledger would consist of a cash account, accounts receivable, inventory, prepaid insurance, prepaid expenses, etc. It's with those general ledger accounts then that you can go look and see how much money is in each one of those accounts. And we typically refer or use a notation of a T account. So if we had cash, then that's a representation of the ledger account. We'd look at the dollar value that went in as a debit and the dollar value that went in as a credit. The next issue then becomes what are debits and credits, and that is a biggie. That's rule number 2. Absolutely, you have to understand that a debit a debit is the left side of an account, and the credit is the right. Do not get confused and think that debit means to increase and credit means to decrease. It's not true. And I've made up a little quick spreadsheet here and popped it in to show you that with our assets, and we have our T account, we have liabilities, owner's equity, that representation of each one of the accounts, you'll notice that if we debit an asset, it increases it, but if we debit a liability, it decreases. So you have to just memorize this little T account example here, and I'll get rid of the red markings here. So you just have to recognize that an asset, a liability, and an owner's equity, then the debit may increase or decrease depending on which one it is. Revenues, expenses, and dividends flow through the retained earnings account, which is an owner's equity. So those items we want to keep track of, whether it's a revenue, expense, or dividends. And so you just have to memorize this plus-minus business. The pluses are what we call the normal balance. It's the dollar, it's where you expect to see dollars. You would expect that you have cash as a debit and accounts receivable is a debit. You would expect accounts payable to be a credit. You would expect common stock to be a credit, revenues to be a credit, expenses and dividends to be debits. Just as a word of caution here, you need to think of expenses and dividends as being negative, so the higher those numbers are, the lower it is of owner's equity. So that's a concept you just need to get clear in your head. Okay. When we get this revenue and expenses and dividends and all these figured out as to what's a debit and a credit, we can now then enter this information, and what I've done is set up a couple quick little examples of a general journal. So with these examples here, we want to invest money in a business. Well, if we go back up here and look, if we're going to invest money in business, then we're going to increase our assets and increase our owner's equity. Notice that the left side, so the debit here, has to equal the credit side. So if we go back down and look at this journal entry here, we have a debit of $100,000, and then we indent to show the credit and put that in the credit column. So any journal entry is going to have at least these two columns. Whoop, whoop, whoop. My little pen went crazy there. Right, it's going to have at least these two columns. So if we invest in a business, we would debit cash, credit common stock. Then if we were going to go out here and purchase a building, then we would debit the building and credit cash. And I changed my margin somehow here. Notice how the dollar sign's up in the air? It's not supposed to be that way, but that's all right. Let's go back to what I was doing. We have a building here in cash. At that point, you need to recognize that the building is an asset and it went up, and the cash is an asset and it went down. So when we buy a building for cash, it's just an exchange of an asset. So to record that exchange of an asset, we would have to capture a debit to the building account, a credit to the cash. If we went out and bought some supplies, purchased some supplies on account, then, sorry, I'm just trying to switch my little markers here. There we go. So if we went out and bought some supplies here, purchased them on account, then supplies is an asset. It needs to be a debit to increase it. Accounts payable is a liability, so it needs to be a credit to increase it. So if we go back up here and look, it should make sense that we're going to debit the supplies and credit the liability. Notice that our assets equals our liabilities, owners, and equity, and that our debits and our credits balance. Right? So our debits and our credits balance. Run through the examples in the book and go through as many of them, that are there, and make sure you completely understand, because again, this is rule number 2, and you have to keep the accounting equation balanced, and at the same time your debits have to equal your credits. And when you get those two in sync together, that's all that accounting is. Everything after that is just details of how to collect the numbers and make the calculations, etc. But if you don't get those two concepts down, then you're never going to understand the rest of the semester. Make sure you read your book. The chapter's got a terrific amount of detail in it. Don't forget, another little note down here, don't forget to look at your, switch arrows, don't forget to look at your review problem. 2 more real quick little definitions. When we get all done with a month, or get done with a quarter or a year, we get to the end of an accounting period, to make sure that our accounts are okay before we go on, what we do is we make a trial balance. And with that trial balance, there's good ones in your textbook. We would just list every account, and we'd list it with its debit or its credit balance. So we'd list all the assets, all the liabilities, all the owner's equity, all the revenues, all the expenses. We'd list them all out. And when we got down to the bottom line here, then if our debits would have to equal our credits. And if not, then we know that we've got an error and our books don't balance. We got to go find that mistake. The last concept here then is the chart of accounts, and that's how we know what accounts that we're going to use. So when you set up a company, you set up the chart of accounts. You decide, are you going to have utilities expense, or are you going to break that down and have electricity expense and sewer expense and water expense? Do you group them together? Do you keep them separate? Do you keep your cars separate from your trucks? Or do you just put them all into one account called vehicle? Whatever it is that you want to do, you set up the accounts with the chart of accounts. And then every economic event, every transaction that you record, you have to use the accounts that are set up in the chart of accounts. All right? Hope this is a little help to you. Hope this is some help to you, not little help, but hope this is some help to you. If not, let me know. Otherwise, I'll assume that these have some value to you, and we'll just keep on going. Again, you can always use these videos as kind of a study guide, because what I'm doing is picking out what I think are the most important issues and trying to emphasize them. So obviously that's what I'll be testing you on. All right, talk to you later. Bye.